For more on today's market action, let's bring in CNBC contributor Peter Boockvar. He is the Bleakley Financial Group Chief Investment Officer. Peter, thanks for joining us. I mean, what do you make of today's action here? What was really the market's biggest worry, in your opinion? And why did we see that 10-year yield go above 4.5?
Well, it was interesting because there were a lot of different factors. The payroll number, of course, as you guys have talked about, and the dip in the unemployment rate, even though it wasn't the cleanest number because we saw that the work week fall to the lowest level since 2010, not including COVID. Then, of course, the Michigan confidence number with the sharp rise in the inflation expectations because of worries about tariffs and the impact it's going to have on the prices that people pay. And then, of course, you throw in the threat of reciprocal tariffs, all combining for that lift back to about 4.5% in the 10-year yield. And the 10-year yield has been falling, interestingly enough, over the past couple of weeks. At the same time, inflation expectations in the TIPS market has actually been rising. If you look at the 2-year, the 5-year, and the 10-year inflation break-evens, we're at 2-year highs, even as long rates have fallen. So I think that's an interesting thing. I think that's a tariff trade in the sense that it could be stagflationary in terms of its impact.
That's interesting. So I was going to ask you what you think your overall impact is of U.S. tariffs. Steve says that he thinks it actually could be deflationary.
Well, the initial reaction could be stagflationary, then a follow-through where prices could fall. You know, the one experience we had, which is helpful, 2018. Well, U.S. manufacturing went into recession in response to those tariffs that led to the Fed cutting interest rates in 2019. I think the only reason why we didn't see inflation then is because these manufacturers did not have the pricing power to pass it on. I think now we're sort of in this post-inflationary world where manufacturers may have more leeway and opportunities to pass it on, not just in a one-time fashion, which is the argument against it being inflationary, but something more persistent in the years to come, obviously depending on the complexion of these tariffs.
Peter, it's Tim. Great to have you. Has the dollar peaked? And in the context of that, also, what do you think about international here, which has really outperformed the U.S.? Germany's going gangbusters, and yet everything we hear about what's going on with their economy, not so good.
Well, on the dollar, we've certainly have had a big adjustment higher in pricing in the tariffs. So if we do get the tariffs, that certainly helps to mitigate it. The question, though, is can the dollar stay strong? And if the dollar happens to weaken, and we still get tariffs, then we lose that dollar mitigation with those tariffs. So I do think there's a possibility because other central banks that have been cutting interest rates, they seem to be coming to the end of their rate cuts as well. And the one currency to me that's most important is the yen here because JGB yields continue to rise. So I think that's potentially a major factor. Now, in terms of international stocks, Courtney said earlier, maybe we're down to the MAG 1. And I do think that investors are all of a sudden realizing that there are a lot of other stocks other than the 7. There's 493 in the S&P, there's 2,000 in the Russell, and you have a whole rest of the world that also trades stocks as well, where valuations have become extremely attractive.